This is not a headline event. There was no emergency meeting, no price spike, no trading halt. And that's exactly why it matters. For 11 consecutive days, the silver market has been operating under a new constraint introduced by China's export regime. On the surface, nothing appears broken. Spot prices are stable. Volatility looks contained. Most people would conclude the system absorbed the change. That conclusion is wrong. What's happening is structural stress without visible price discovery. The kind of stress that builds inside settlement chains, delivery schedules, and risk models long before it shows up on a chart. This is not theory. This is not forward-looking speculation. This is a live market adjustment happening in real time. When someone like Elon Musk says, "This is not good," he's not talking about silver as a trade. He's talking about inputs, availability, and the reliability of supply chains that modern industry quietly assumes will always function. In this video, I'm going to walk you through what is actually breaking beneath the surface, why the public-facing numbers are misleading, how the mechanics are shifting, and why this kind of stress doesn't resolve cleanly once it starts. If you want clear, institutional-style analysis that explains how markets really work, not headlines, not hype, make sure you subscribe. I monitor metals flows, derivative positioning, and settlement stress the way credit desks monitor funding markets. When something breaks here, it doesn't break loudly at first. It breaks quietly, then all at once. Let's define one term early: basis. The basis is the difference between the paper price of silver and the cost to actually obtain deliverable metal. Think of it like airline tickets. The advertised price online is meaningless if every seat is gone, and the only option left is paying someone at the gate. The ticket price didn't change, but access did. Right now, the official story you'll hear is simple. China adjusted export licensing. Supply chains are rebalancing. Markets are digesting the change. That's not what actually happened. What happened is that a core assumption embedded in the silver market's plumbing quietly failed. To see why that matters, you have to understand how silver normally moves through the system. At the first layer, you have mine output and recycled supply. That metal flows to refiners, then to industrial users, mints, and vaults. This layer is slow, physical, and constrained by logistics. At the second layer, you have wholesale distribution. Large bars move between regions. This layer relies on trade finance, shipping insurance, and export permissions. It's capital intensive, but predictable, until it isn't. At the third layer, you have futures and forwards. This is where liquidity appears deep. Market makers quote tight spreads because they assume they can always source metal later. This is where most price discovery happens. At the fourth layer, you have leverage. Funds, ETFs, and industrial hedgers roll positions instead of taking delivery. Margin efficiency depends on confidence that delivery is always possible. Each layer depends on the one below it functioning normally. Here's the assumption that broke. The silver market assumes that any regional shortage can be arbitraged away. Metal can always move from where it is to where it's needed at a price. China's new export regime didn't ban silver. It slowed it. Licenses became conditional. Approvals became discretionary. Timing became uncertain. That seems minor until you look at the numbers. Here's the anchor number. Roughly 35% of global refined silver flows through China at some point in the chain, either as refined output, semi-finished product, or recycling throughput. That doesn't mean 35% disappears. It means timing and certainty vanish. Now derive the second number. The global silver market runs on about 6 to 8 weeks of usable inventory once you strip out metal that is technically available but economically immobile. If even 1/3 of that flow becomes delayed by, say, 3 weeks, you don't lose supply, you lose synchronization. That's where the math breaks. Under normal conditions, market makers assume they can source metal within 5 to 7 days if they need to make good on a delivery. That assumption is embedded in bid-ask spreads, margin requirements, and position limits. Under the new regime, that sourcing window stretches to 15, 20, sometimes 30 days. On paper, nothing changes. In reality, everything does. Here's the internal calculation risk desks are now forced to run. Baseline assumption. A short futures position can be covered with physical metal sourced within 1 week at a premium of 1 to 2% over spot. New condition, physical availability is delayed and premiums jump to 6 or 7%, if metal is available at all. Catastrophic outcome, the futures position marks to market daily, but the hedge cannot be completed. Losses accumulate, not because price moves, but because settlement certainty evaporates. This is where stress tests fail. Models don't break when prices rise. They break when correlations collapse. And once that happens, liquidity doesn't leave gradually, it gaps. Liquidity collapse is not about fear. It's about risk limits. Imagine a bar with one exit. People are calm until they realize the door is partially blocked. No one panics at first, but each person moves faster, spreads widen, and suddenly no one is willing to stand near the doorway. In silver, that doorway is deliverable supply. As premiums rise, market makers widen spreads. As spreads widen, volumes fall. As volumes fall, volatility spikes. Not from buying, but from absence. This creates a feedback loop. Higher volatility increases margin requirements. Higher margins force position reductions. Position reductions hit paper prices, even as physical becomes harder to find. This is the split reality phase. On one side, you have price charts showing stability. On the other, you have industrial users quietly paying up to secure forward supply. Paper silver says nothing is wrong. Real silver says everything is tight. These two realities cannot diverge indefinitely. Eventually, one of three outcomes must occur. The first is the fantasy outcome. Supply magically normalizes, export approvals accelerate, premiums compress without incident, probability low. The second is the corrupt outcome. Cash settlement replaces delivery, contracts are honored in dollars instead of metal, trust erodes permanently, probability moderate in stressed jurisdictions. The third is the managed outcome, the one unfolding now, selective rationing, higher premiums, quiet intervention to prevent visible failure, probability highest. This is not collapse, it's controlled damage. So what does this mean for you? Do not panic. Panic is for people watching price, not structure. Clarity comes from understanding constraints. This is a market where availability matters more than valuation, where the question isn't, is silver expensive, but is silver obtainable on time, in size, without repricing the entire chain? If you want to stay grounded, there are indicators to watch, weekly, not obsessively. Watch physical premiums, not spot price. Watch exchange warehouse drawdowns relative to delivery volume. Watch lease rates. When they rise, it means metal is being borrowed, not traded. Watch bid-ask spreads during calm price action. That's stress hiding in plain sight. Zooming out, this isn't about silver alone. It's about a broader shift from frictionless globalization to managed fragmentation, from just-in-time supply to just-in-case hoarding, from price discovery to access discovery. Metals feel this first because they sit at the intersection of industry, finance, and geopolitics. Elon Musk's comment wasn't about a chart. It was about the realization that inputs once taken for granted are becoming conditional. The question is not if these frictions surface elsewhere. The question is how long markets can pretend they're temporary, stay with the mechanics, stay calm. And understand this, systems don't fail when everyone is watching. They fail quietly until they don't. Let's bring this to a close. What you're watching in silver right now is not a commodity story. It's a system story. Markets are still quoting prices as if availability is guaranteed, logistics are neutral, and settlement is automatic. That world no longer exists. It hasn't collapsed, but it has changed. Quietly, structurally. Here's the critical point. Nothing in the silver market is broken yet. Contracts are clearing, prices are trading, volatility is contained, and that's exactly why this matters. Because the stress is not expressing itself through price. It's expressing itself through timing, premiums, permissions, and conditional access. Those are not variables that traders model well. They are variables that engineers, procurement teams, and risk committees worry about when failure is no longer theoretical. China's export regime didn't remove silver from the world. It introduced friction into a system that was priced for zero friction. And once friction appears, leverage becomes dangerous, liquidity becomes selective, and confidence becomes fragile. This is where it changes. From here forward, silver will not be valued purely as a metal. It will be valued as a deliverable input with geopolitical constraints. That shift doesn't happen overnight. It happens through small decisions, wider spreads, higher margins, shorter tenors, more conservative assumptions. Each one looks rational on its own. Together, they reshape the market. The question is not whether silver prices explode tomorrow. That's the wrong question. The real question is how long markets can continue to clear paper claims smoothly while the physical layer tightens underneath them. Because history is very consistent on this point. When price and availability diverge long enough, price eventually catches up. Not explosively, but discontinuously. Before you go, here's the only call to action that actually fits this moment. If you want to understand markets before they move, if you want to see stress before it shows up in price, then stay focused on structure, not headlines. Subscribe if this kind of analysis is useful to you. Not predictions, not hype, just how the system actually works when assumptions start failing. If you think this conversation matters, share it with someone who still believes price is the signal. Because by the time price reacts, the opportunity to understand is already gone. And if you want more breakdowns like this, metals, liquidity, macro plumbing, let me know in the comments what market you want dissected next. Stay calm, stay analytical. And remember, the market always tells you what's coming. Most people just aren't listening to the right part of it.